Stock market rallied in the United States here today on positive retail sales news and also U.S. industrial production numbers. It felt like a little bit more of a risk-on type of a day as we saw a lot more of those NASDAQ-oriented, tech-oriented types of companies do quite well, whereas some of our more defensive areas like consumer staples struggled just a little bit. We also saw the NASDAQ composite just narrowly miss an all-time high in terms of its closing high, as did the S&P 500. So on the whole, it was a pretty positive day. We did have one of our indices flip back over to a weekly bearish posture, so I'll explain that here in just a moment. And then we'll also get into a trade application example where I wanted to focus on selling a put on a fairly high-quality healthcare company in order to try to own it at a slightly lower price than where it's trading today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 16th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into our description area and make sure you're signed up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we'd really appreciate it if you guys would click like and retweet on any of our Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Let's get things started here with our heat map of the S&P 500 today to kind of get a sense of what stocks maybe helped move the markets here today. Naturally, the green squares and rectangles that you see here are the ones that were the stocks that did well today. The ones that are listed in red are the ones that were a little bit underwater here today. So, of course, some of the bigger blocks represent the bigger and more important companies with the larger market caps. So as an example, Tesla down below here was one of our bigger movers here today. It was up 4%. Of course, that stock being in the news here in the last couple of weeks with Elon Musk asking the Twitterverse whether he should be selling his stock or not. And so that stock has been a bit more volatile than usual here in the last couple of weeks. But today, nice upside move there out of Tesla. We also saw a long-time dividend growth investment holding of some of my classes over the years. Qualcomm do quite well here today. It probably doesn't get quite as much press as other stocks like NVIDIA, AMD, Intel, and the others, but Qualcomm is a very high-quality dividend growth investment that is also part of that semiconductor field. Of course, has a good relationship with Apple these days, as it needs to, as it has a lot of communication technology within those Apple devices that are made by Qualcomm. But anyway, that stock shot higher by nearly 8% here today. Speaking of dividend stocks, we also saw that the two big home improvement companies, Home Depot and Lowe's, also had very strong days today. Home Depot was up 5.7% today, and Lowe's was up 4.2%. So those are some of our bigger winners to the upside. You'll also notice that just in general, you see a lot of green over here on the left-hand side, and that's where our information technology area is. Whereas over here on the right-hand side where you see the consumer staples, notice there's a lot of red over here, as I kind of alluded to in the intro. So stocks like Walmart was down 2.5% today. Philip Morris International was down 2.4% today. So again, felt a little bit more like it was a bit of a risk-off type of a day, all else being equal, where money was kind of going back into the discretionary and technology types of areas and avoiding some of those more interest rate sensitive areas of the market. We'll talk about this a little bit later, but we did have a nice move higher in interest rates once again here today, so that might have influenced the markets to a degree. Let's go ahead and now jump into our traditional 4 grid here, and this is chart 4B for those of you following along at home with your own charting package. As you can see, all of these securities were higher here today. However, I did want to start the conversation by pointing out a change all of a sudden. For the very first time in over a month, there's a posture change. And that posture change is here in the lower right-hand corner with the Russell 2000. Now, let's do our best not to make too much of it because it is a very small indication at this point. Nonetheless, it is occurring, so it's helpful to point it out, and that way you guys are aware of it. But the small cap index now does have a weekly bearish intermediate posture according to the market forecast technical indicator. Remember, that technical indicator can be found at the bottom of these charts. You can find it on the Thinkorswim platform. Yours, from a default perspective, may not look quite like David and I's here, as we kind of dress these up a little bit with color coding and different things like that for our premium members. But you do have access to the kind of default generic version of the market forecast technical indicator on a Thinkorswim platform. Of course, Thinkorswim is owned by TD Ameritrade. TD Ameritrade is owned by Schwab, so it's hard to kind of keep all of that straight these days. But many of you have used the Thinkorswim platform over the years, just like David and I have alongside our predecessor company, InvestTools, that we used to work for. So a lot of you are familiar with the Thinkorswim platform, and you have access to that market forecast technical indicator. And one of the ways that you read a posture change on that indicator is by looking at the green line, which is considered our intermediate line, and by default that is what we are using when we're using or when we're delivering these YouTube presentations to you. Remember, you can also establish a posture on the near-term line and on the momentum line. The near-term line I tend to think of more for swing traders, which is effectively what we'll be doing tomorrow morning in my factor-based swing trading class. We actually use that blue near-term line there. But in general, the more popular line is that green intermediate line, where you're thinking in terms of intermediate time period. In other words, months, not weeks. If you're thinking about weeks, that's near-term line. If you're thinking about days, that's momentum. Of course, we don't do a whole lot of day trading, as it's a little bit more difficult to accomplish with as much volatility as you see throughout any given day as a result of news and macro conditions and different things like that. But anyway, as you can see, Russell 2000 did slip down to 79.43 and falling. So now that that green line is below the upper reversal zone and is falling, then that's why that background color of the chart has switched from green to pink. And this is the very first time it's been pink since going all the way back here till mid-October. It looks like it was October 12th. So it's been over a month since we've had even a weekly bearish posture on the Russell 2000. But because this is still so close to the upper reversal zone, remember, if this were to go right back into 80 tomorrow, that background color would flip right back to green. So that's why we consider it weakly bearish, not strongly bearish. Once that green line starts traveling lower a bit more, and it appears that it is kind of confirming that there's a little bit more of a pullback in store with this move, it'll eventually cross below 50, and at that point then we'll start seeing that darker shade of pink on the chart. But right now, just considered weakly bearish. Do we need to make a lot out of it? Do we want to go and take a bunch of bearish trades as a result of this? Probably not. The way that I think of this is it's one indication, just like there are so many, technical indicators out there that could produce a lot of information for you, both bullish and bearish. But because we are still trading above this rising 30-day moving average here on the Russell 2000, and we are in a traditionally seasonally strong time of year for small cap stocks, I tend to want to give them the benefit of the doubt. So did we get a little bit overstretched to the upside with all of these big candles that we saw here? It seemed like it was kind of a pattern there every other day. So that one, that one, that one, and that one are these massive candles that close near the highs of their day. That was a bit aggressive, right? You don't see that type of behavior all that often. So is this kind of the cooling off period to kind of digest those gains that we saw back here? I think that's entirely likely in this particular circumstance. Obviously, things do change on a day-by-day basis, and so we need to keep our eye on the market and what news stories might be affecting things. But right now, I'm going to move forward just assuming that the small cap universe will be doing reasonably well until the end of the year at least, and that's despite the light pink background color that we're seeing there. With the other three indices, of course, we still have our dark green background color instead of light pink, and so on these other three, for the Dow Jones, it was up 0.15% today. For the S&P 500, it was up 0.39% today, and the NASDAQ Composite was our leader today. It was up 0.76%. On all three of those charts, you can see the background color is dark green, telling us that these green intermediate lines are still in the upper reversal zone above 80, and therefore we still consider those to be strongly bullish postures. You will notice that of those three, the next one likely to lose its posture at this moment in time is the Dow Jones Industrial Average. You'll notice that its intermediate line is at 81 right now, and again, if it were to slip below 80, then it's going to have the same look as the Russell 2000 currently does, whereas there's a little bit more wiggle room there at 89 and 86 respectively on the S&P 500 and the NASDAQ Composite. So as I mentioned in the intro, while we weren't particularly close to a new intraday all-time high, both the S&P 500 and the NASDAQ Composite narrowly missed a all-time closing high. So for the S&P 500 here, that was represented by this candle that I'm kind of circling with my mouse on November 8th, and the high on that close was 47.01, and you can see right now we are at 47 right on the dot pretty much here for our closing price today. So in other words, one more point to the upside would have been a new closing high for the S&P 500, and therefore it's entirely possible we get it as soon as tomorrow as long as markets don't crater. And then NASDAQ Composite's very close to their closing price high as well. So we could wake up any given day and see new all-time highs on either one of those indices. With the Dow Jones and the Russell 2000, they're a little bit further away from where they were trading a week and a half ago, and so it's going to take maybe a few days to get those back to their highs. But all of these are still in reasonably good shape, trading above their rising 30-day moving averages. Let's go ahead and take a look at our three green arrows setup now. And this will be chart 4D for those of you following along at home. Remember that the three green arrows that we're looking for on each of these charts represents the 30-day moving average, the MACD histogram, and the stochastic. And at this moment in time, we actually don't have any of these four charts with either three green arrows or three red arrows. In other words, we've got a mix of green and red arrows on all four of these charts. In other words, we have a little bit more of a kind of sideways feel to this market than we did perhaps a couple of weeks ago when we were kind of in this relentless surge to the upside. We've now just kind of started coasting sideways. So we're not to the point where we're breaking support levels down below its moving average. So that's why on all four of the moving averages, we are retaining our green arrows on all four of our charts there. But you will notice that we have red arrows on all four of our charts on the MACD histogram, suggesting that we've got a loss of momentum there. So we were cruising to the upside very, very quickly, and then it just kind of seems like we're not continuing to scale the mountain. We're just more coasting at this moment in time, going sideways. So we have experienced a bit of a loss of momentum here, but as I mentioned a moment ago, it wouldn't take too much to get the NASDAQ Composite and the S&P 500 to new all-time highs. And if that were to occur, we could very well be back to three green arrow status before we know it. In fact, with the S&P 500 and the NASDAQ Composite, you'll notice that we have a gray bar there on the MACD histogram as opposed to yesterday's red bar. And what that is suggesting is that we're kind of rounding the corner and heading back towards the zero line on the MACD histogram. Once we get above that zero line, we would then plot a green arrow once again. So maybe a little bit of positivity as a result of what we saw here today. We are not, by the way, experiencing that on the Russell 2000. Russell 2000 was up today, but the range was rather small, and we were not going up as aggressively as we were back here when these MACD histogram bars were green day after day after day, kind of climbing Mount Everest there and then rolling over, and we are just merely kind of going sideways here. And you can almost visualize that as well just looking at the price action. Like with the S&P 500, you can see just a touch of progress here over the last 4 days. You see the same thing with the NASDAQ Composite, but the last 4 days on the Russell 2000 is in fact sideways, right? We're not actually going up. It is truly sideways in that case. So anyway, as of this exact moment in time, we've got a couple of different charting systems here that suggest that of these four major U.S. equity indices, it appears like the Russell 2000 is currently our laggard. And, that might change in the future, but right now they're just not really kind of participating alongside the mega cap indices out there that have benefited from stocks like Tesla and Qualcomm and some of those stocks that I'd mentioned before, Home Depot, that have been doing a little bit better here recently. All right, let's go ahead and now take a look at our 1040 crossover method. And as you can see, the 1040 crossover method suggests that all 4 of these charts are still in good long-term shape. What we're using here is a 10-week moving average represented by the orange line and a 40-week moving average represented by the blue line. As long as the orange line is above the blue line, the background color of the chart will be green. Now keep in mind these are weekly candles here, so this is a longer term view that we're looking at compared to the other charts that we've looked at here tonight. This one is a 3-year weekly candle chart. So over the last 3 years, you can see that this strategy, as simple as it sounds, is reasonably successful. We had a little bit more chop and slop with the Russell 2000 where it might have been harder to make a bit of money using these signals on that particular index. But on all 3 of these others, you can see that the background color has been painted mostly green over the last 3 years with just a few weeks here and there painted in pink. So for the most part, had you been bullish, the NASDAQ composite for the vast majority of the last 3 years, you're likely quite thankful for that. So as of this moment in time, we're in pretty good shape. In fact, we're in a little bit better shape right now than we probably were about a month ago. Remember, September caused a little bit of chaos in the stock market, and as a result, the 10-week moving average started to come down and pinch towards the 40-week moving average. And you can see on the Russell 2000, that orange line got pretty close to touching the blue line and now has started to ramp back higher. And you'll notice that with the PPO down below as well, kind of starting to bounce higher there. So remember, if that PPO green line down below were to cross the 0 line, that dotted kind of gold or orange line that you see down there, that basically means that those 2 moving averages are crossing up above. And so all 4 of these green lines are above the 0 line, telling us that we still have, those golden crosses that are in place, and they have been in place. Remember, all 4 of these charts have had golden crosses since basically the summer of 2020, just after the coronavirus wipeout that we experienced in the spring. So all of these have way more than a year's worth of bullishness just by this one basic and simple technique of using a 1040 moving average crossover. Let's go ahead and take a look here now at some 12 grid analysis. And we will start with chart 5A. Now, a couple of things that caught my eye today are what's going on in the 2 lower corners, US dollar and the 10-year US Treasury yield. Notice that the US dollar was up once again. In fact, I think David was tweeting quite a bit about the dollar today. Remember, he used to teach classes over at our predecessor company about currency and currency trading. So he is a very knowledgeable fella when it comes to the various currency pairs all around the world. And so he was chatting a lot on Twitter here today about the various currencies and how he's kind of interpreting things. But one of the things that he pointed out is that we actually have an overbought cluster signal here on the US dollar. And that's pretty rare. It's been quite a long time since we've seen that signal. Keep in mind that our proxy for the US dollar in this particular case is UUP, and that is based upon the US dollar versus a basket of foreign currencies. And the most important one by far is the euro. So one of the points that David was trying to make is it's not necessarily that the US dollar is extremely strong. More to the point is that the euro is extremely weak versus not just the dollar, but across a whole bunch of other currencies across the world as well. So keep that in the back of your mind. The US dollar has to be matched up with lots of other currencies out there. And in some cases, sure, the US dollar might be strong like it is versus the euro right now, but in other cases, it might be weak. So, take this for what it's worth, but you do need to kind of peel back the onion, so to speak, and do a little bit more work to see if the US dollar is actually strong across the currencies that you care about. But in this particular case with UUP, you can see it's been on quite a move here lately. 4 out of the last 5 days to the upside. Not only that, but basically closing at the highs on all 4 of those last 5 days. You can see these open candles right here suggest that we closed at the high of the day. So are we a little bit overheated right here? Could we experience a bit of a pullback in the dollar? Entirely possible. After this type of a move, we're probably kind of pushing our luck up here. Maybe there's another day or two of clusters that occur after today, but you're kind of up at this level where you're at a pretty extreme level above that moving average, and something as liquid as the US dollar traditionally doesn't get to, extreme standard deviation types of moves because there's so much money sloshing around in it. So be prepared for a possible near-term pullback there in the US dollar. But remember, that doesn't have to mean that your new intermediate posture is going to be bearish. It just means that we got a little bit overheated, but the trend remains to the upside. The TNX over here on the lower right-hand corner is at 1.63 is where we ended here today. And so keep in mind that, we're back above that rising 30-day moving average. Remember last week when I was with you, we were talking about how we had sliced straight through that moving average, and it was starting to look a little uglier there for Treasury yields, which was a little bit odd because that's one of the defining characteristics of calendar year 2021 thus far is strong yields or increasing interest rates. So it kind of looked like we were going to give some of that back, but we've had one heck of a reversal there as well, very similar to what we've experienced with the US dollar over here. And we're back above that rising moving average once again. Remember, that can be somewhat supportive of financial stocks, somewhat more difficult in that environment for heavily indebted securities like a lot of the utilities and real estate investment trusts that are out there. Other movements that you'll want to be aware of here today. Gold was down today. Now remember, when the dollar is strong, oftentimes commodities are weak. That's what's made this past week a little bit strange, is that correlation or that relationship didn't really hold up. But today it kind of clicked back into place, so to speak. With the dollar up, gold was down here. This is actually the second straight down day for gold, but yesterday was more of a doji looking candle there, where you didn't really have a lot of movement. This candle today was quite a bit uglier on gold there. It almost gives you the impression that it's going to try to roll over here and head back down towards that moving average once again. So let's keep our eyes on that possibility. But as of this moment in time, despite today's 0.72% pullback, we still do have a strongly bullish posture there on gold, and we're still above that rising 30-day moving average. Oil was up just fractionally today. It wasn't a big move, but it was up. However, oil's been tracking sideways a bit more. We had that conversation yesterday in my top-down trend trading class about how when we're reviewing the various sectors out there, energy continues to fare quite well under various ranking systems. But if you were to look at the technical analysis of the chart, you've seen sideways price behavior over the last couple of weeks. So while the last 3 months still look very promising or impressive, I should say, for something like oil and the oil stocks, the last 2 weeks of this 3-month period has really been just going sideways, if not a touch lower. As you can see, oil is actually trading below its 30-day moving average at this moment in time. Now, take a look at the bond prices across the board here. We do have bearish postures. With high yield bonds, it's a strongly bearish posture, with the other two weakly bearish. But again, that's a little bit surprising given where we were 1 week ago. It looked like TLT was breaking out to the upside. Now remember, this is kind of like a Rorschach test with the Treasury yields over here in the other corner. When Treasury yields go up, naturally Treasury prices go down. And so you're kind of seeing that activity taking place there. But it's been wild and quite volatile here in the last 2 weeks, whether you're looking at bond prices themselves or whether you're looking at interest rates, where you've had just V-shape reversal types of patterns that are involved there. You could call this one, I suppose, an A shape over here, and this one more of a V shape over here. But the point is, aggressive move up and down depending upon what you're looking at there in just the last 2 weeks. In terms of our stock markets up at the top, you will see that the United States market did outperform developed foreign stocks and emerging foreign stocks here today. All three of them retain their strongly bullish posture. All three of them continue to trade above rising 30-day moving averages. Let's go ahead and pull up our 12 grid for the sectors now, and that will be chart 5C. And as you can see here, we've only got 2 charts right now that have pink background colors. And just a friendly reminder that this is a market cap weighted version of these sectors. For those of you that are premium members, the 12 grid that I was sharing with you in class on Monday is slightly different, and you would find that one as chart 1G right here. These are our equal weight sectors. Remember, that's a different chart setup than the traditional market cap weighted ones, and sometimes give you slightly different perspectives. What I would say is that consumer discretionary from an equal weighted perspective is now in line with what we've been seeing from a market cap weighted perspective there for quite some time. From an equal weighted perspective, I would say that communication services probably looks the worst up here. This is EWCO if you're looking to pull that up on your own platform at home, the equal weighted communication services ETF. But you can see kind of a bounce down and away from that falling 30-day moving average here today. Back on over here to the traditional 12 grid with the market cap weightings, you can see that communications also is looking poor compared to these other market cap weighted sectors, but it probably doesn't look as bad as what we just saw a second ago there from an equal weighted basis. And so what that would tell us is that the large cap communication stocks are holding up a bit better than some of the smaller ones out there. So maybe like the Alphabets and the Facebooks / Metas of the world might be holding up a little bit better here in the last couple of weeks than your mid cap and small cap types of communications companies that are out there. In terms of which areas did the best here today, you can see that discretionary was up 1.58% today. That's as a result of 2 stocks, Tesla and Home Depot that I had mentioned before. Remember, those are 2 out of the top 3 alongside Amazon. That would be the most influential on a ticker XLY here. Technology also had a very strong day, partially perhaps due to the strength in semiconductors that I mentioned before with Qualcomm. You can see technology was up 1.05% today. In terms of downside movers today, we did see that the communications that I mentioned before was the worst performer, down 0.75%. And then we also had staples and real estate nearly tied for second place there. They were down 0.63% and 0.62% respectively. And remember, those 2 on the bottom do have a bit more of that interest rate sensitivity. And so that might have kind of played a role in some of their underperformance today. But on the whole, these sectors from a market cap perspective have remained relatively resilient during this market period that we find ourselves in right now. Let's go ahead and get into our trade application idea. And remember, the trade is already done. I've already sent out the heads up on that trade idea on Telegram. And those of you that are premium members will have received that during the trading day. And so the trade that I ended up doing was Amgen. And of course, many of you are familiar with that large cap healthcare pharmaceutical / biotech type of a company. And it struggled here recently. It really has. We've actually done a trade like this in the past. What I'm doing is I'm selling a put on it. So we did this on Amgen maybe 2 or 3 months ago as well. And those particular contracts expired worthless, which remember in a case like you're selling puts, that's a good thing, right? So it sounds like, when you use the term worthless, it sounds like you did poorly with that trade. But that's actually a good sign when you're selling puts. When you're a put seller, what you're doing is you are putting yourself in the obligation to buy a company at a strike price that you select if it closes below that price on expiration day. Sometimes you have early exercises that take place, but remember, that's very rare on the put side of the equation. On the sold call side of the equation, early exercises are a little bit more prevalent because of the opportunity for someone who owns a call to convert it into stock, which would then entitle them to a dividend payment. But that process doesn't work the same way on the put side of the equation. So for the most part, you can find that your trades will go until expiration day if you so desire. And if on expiration day the stock is trading below the strike price that you sold, then you're on the hook for buying 100 shares of that stock. And remember, Amgen is a somewhat expensive stock at $200, in this case actually $205. So to buy 100 shares of it, for some of you might be a little bit of a big bite. For others, maybe less so, but everybody's in a different position there. But just keep it in the back of your mind. So what I did was I sold the 195 strike in the month of December on Amgen, because that was the one where you were closest to the 1% return on risk. 195 on the chart is approximately right here. I'm kind of circling it with my mouse. Now you'll notice that Amgen is already in what I call the blue zone of this dividend stair-step chart that we use for my longer term investing classes, like the dividend growth investing class that I taught today, where we bought a tech stock, an old school tech stock. But anyway, the dividend stair-step chart is a way for us to determine whether we perceive a stock to be overvalued or undervalued based upon a company's current yield compared to its historical yield throughout the past decade. And so when you're in the blue zone, like you are right here with Amgen, it is perceived that this is an undervalued security, all else being equal, that might be appropriate for a long-term investor. If it were up here in the orange zone, like it was back here in 2015, then that's less enticing up there. When it pops back down into the blue zone, then we're interested. So we are down here in the blue zone right here. And I actually like Amgen quite a bit as just a standalone investment. Like I explained to my students, you don't see me put down long-term investments all that often in the market outlook videos, and it has nothing to do with my desire to put down long-term investments. It's just that we need to kind of recycle cash in these paper money accounts a lot. If we did nothing but long-term investments, then all of our cash would be soaked up after a couple of months and we wouldn't have any more buying power to trade with. So don't read too much into that. I actually think you could buy Amgen here as a legitimate long-term dividend growth investment outright in the stock market and do reasonably well for yourself in the coming years. But because I need to recycle that cash a little bit more actively, I'm going to do what's known as a put sale here. And as I mentioned, December 195. So what that means for me is I took in money today, a premium up front that's mine to keep and do what I want with. And in return, I am assuming somebody else's risk. Whoever owns that put that I sold has the right to cash in that contract that allows them to sell their Amgen stock at 195 or just simply speculate on a further move down. But basically what that means in layman's terms is if this stock were to go down below 195, it's likely that that contract would have an assignment or an exercise, and I would need to be on the hook for buying 100 shares at $195. And that's regardless of whether it's at 194 or if something disastrous happens and it comes all the way down to 150. So remember, there is more risk in a trade like this because it is not as risk defined as what you would find in like a normal bull put spread or something along those lines where you can define that risk a little bit better. But again, I think of Amgen as a nice blue chip company. Its yield is already 3.43%. Obviously, if the stock were to drop another $10 where we would be on the hook for buying it, our dividend yield would even be more enticing, probably above 3.5% at that point, which I think is a fair deal for a company that is as high caliber as Amgen is. So that's what I had for you here this evening. Hope you enjoyed the presentation. If you did, I ask one simple thing out of you. Just click like for me there on Twitter. Remember, there's 4 different ways to find that particular tweet. It'll be pinned to the top of my timeline for those of you that go directly on your Twitter app or on the web. You can also find it under the widget, under the video that you're watching on the Market Scholars website if you watch the video there. You can also find the tweet link in the description area underneath the YouTube video for those of you that watch this directly on YouTube. And then you can also find the tweet link on the emails that we send out to all of you who are on our email distribution list. So however you choose to participate in that, it all kind of cycles back to the same end result. And last Thursday, you'll notice that I didn't do the video. I just did the write-up on our website because we were at 99 likes. If there would have been one more single person that would have clicked like out there, I would have done the video. Now, I'm kind of glad that I didn't because I've been busy. Some of you have followed me on Twitter know that I've got my hands full with fostering a puppy right now. And so that particular day, I had a lot of other things on my mind. But nonetheless, I will commit the same thing to you that I always say, which is, if you guys want to see these videos get done and you support them on Twitter and we get over 100 likes, I'm going to make it my priority to do the video for you on Thursday. If we're under 100 likes, then I'm going to look at my schedule and see if there's anything else I need to be doing at that time. And if so, then I would likely just end up doing the write-up. So I'll let you guys decide on that. If you don't want to see a video on Thursday, don't click like. If you do want to see a video on Thursday, then click like. With that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.